Right now, millions of people are waiting for interest rates to fall, waiting for inflation to disappear, waiting for the economy to feel normal again, waiting for the stock market to send a clear signal. And while they wait, history may already be happening. 5 years from now, many people will look back at this exact period and say, asterisk, I should have invested. Asterisk, not because the opportunity was hidden, not because nobody warned them, but because they were waiting for certainty. And certainty never arrived. If you study financial history carefully, you'll notice a pattern. The greatest investing opportunities rarely look like opportunities when they're happening. They look uncomfortable. They look uncertain. Sometimes they even look frightening. And that's exactly why most people miss them. Because human beings naturally seek comfort. We want reassurance. We want proof. We want everyone else to agree before we act. But the stock market has never rewarded comfort. It rewards patience. It rewards discipline. And most importantly, it rewards people who understand the difference between investing and waiting. Warren Buffett has spent decades teaching this lesson. Yet millions of investors still misunderstand it. People think Buffett became successful because he could predict the future. That's not true. People think Buffett became successful because he always knew which stock would go up next. That's not true either. The real reason Buffett succeeded is much simpler. He understood that wealth is built by owning productive assets for long periods of time. And that's a lesson that becomes incredibly important during uncertain times. Because while everyone else focuses on headlines, successful investors focus on ownership. What a stock really is. Let's start with a question. What exactly is a stock? Most people think they know the answer, but many don't. They see stock prices moving every day. They hear financial news talking about markets. They watch charts rise and fall, and slowly, they begin thinking stocks are nothing more than numbers on a screen. But Buffett sees something completely different. Imagine a local business, a coffee shop. Every day, customers arrive. Products are sold. Revenue is generated. Profits are earned. Now imagine you own a piece of that business. If the business grows, your ownership becomes more valuable. If profits increase, your ownership becomes more valuable. That's investing. Public companies work the same way. When you buy shares of a quality company, you aren't buying a ticker symbol. You're buying ownership in a business that employs people, creates products, generates profits, and hopefully grows over time. This simple idea changed the way Buffett looked at investing. Because once you begin thinking like an owner, daily market movements become less important, and long-term business performance becomes more important. Why most people miss? Here's where things become interesting. Imagine two people. Both have money available to invest. Both understand the basics. Both want financial freedom. Yet their behavior is completely different. The first person waits. The second person invests gradually, month after month, year after year. The first person keeps searching for the perfect moment, the perfect economy, the perfect market, the perfect conditions. The second person understands something important. Perfect conditions rarely exist, and waiting for perfection often becomes a lifelong habit. That's one reason many people never start investing. They spend years preparing, years researching, years watching, but very little time actually participating. Meanwhile, the market continues moving forward. Innovation continues. Businesses continue growing, and time continues passing. The cost of sitting on the sidelines. One of the biggest risks in investing isn't losing money. It's failing to participate. Because while losses are visible, missed opportunities are invisible. Nobody sees the gains they never earned. Nobody feels the wealth they never built. And that's what makes waiting so dangerous. Imagine someone who kept delaying investments for 5 years. Maybe they were waiting for a recession. Maybe they were waiting for lower prices. Maybe they were waiting for certainty. Regardless of the reason, those years are gone. And unlike money, time cannot be recovered. That's why Buffett values time so highly. Because time is the engine that powers compounding. Without time, compounding has nothing to work with. History rewards patient investors. Let's travel back in time, not to a moment of celebration, not to a moment of optimism, but to a moment of fear. The year was 2008. Banks were collapsing. Financial institutions were failing. Stock markets were crashing. News headlines sounded terrifying. People feared the entire financial system might break. At that moment, very few people were talking about opportunity. Most people were focused on survival. Many investors sold their stocks. Some promised never to invest again. Others moved everything into cash. Fear took control. And honestly, it's easy to understand why. When everyone around you is panicking, staying calm becomes difficult. But here's what history reveals. Those who continued investing during that period, those who remained patient, those who believed in long-term ownership, eventually experienced one of the strongest market recoveries in history. The people who felt safest often missed the recovery. The people who stayed invested benefited from it. And that's a lesson Buffett has repeated throughout his entire career. The market transfers wealth from the impatient to the patient. The biggest investing mistake. Most people think the biggest investing mistake is buying the wrong stock. But Buffett would probably disagree. Because the wrong stock can hurt your portfolio. But failing to invest at all can hurt your future. Think about it. A person spends years earning money, years saving money, years planning for financial freedom. Then fear convinces them to keep waiting. Waiting for the market to feel safer. Waiting for better news. Waiting for experts to agree. Waiting for certainty. And while they wait, time quietly moves forward. That's the real cost. Not just missed returns. Lost years. And in investing, years are incredibly valuable. Because every year gives compounding more time to work. Why Buffett loves ownership. One of the reasons Buffett remains calm during market declines is because he doesn't focus on stock prices. He focuses on businesses. That's a huge difference. Most people open an investing app and immediately look at prices. Buffett looks at value. Imagine you own a farm. Would you check its value every 5 minutes? Of course not. You'd focus on production, growth, long-term results. Now imagine owning part of a great company. Why should your mindset be different? A temporary drop in price doesn't automatically change the quality of the business. And that's exactly how Buffett thinks. He sees stocks as ownership in productive assets, not lottery tickets, not gambling chips, not quick trades. Ownership. Fear creates opportunity. Here's one of the strangest truths about investing. The moments that create the most fear often create the most opportunity. That sounds backwards, but history supports it. When markets are booming, opportunities are harder to find. Everyone is optimistic. Everyone is buying. Prices often become expensive. But during periods of fear, something different happens. Good businesses sometimes become available at attractive prices. Not because the businesses suddenly became worthless, because emotions took over. And emotions can be powerful. Fear causes people to focus on short-term pain. Long-term investors focus on long-term value. That's why Buffett's famous quote remains so important. Be fearful when others are greedy, and greedy when others are fearful. Simple words, extremely difficult to follow, because human psychology naturally pushes us toward the crowd. The secret most people miss. Many people believe investing success comes from finding the perfect stock, the perfect company, the perfect opportunity. But Buffett's success tells a different story. The secret isn't perfection, it's participation. Because even the greatest businesses experience setbacks. Even the strongest markets experience declines. Even the best investors make mistakes. What matters is staying involved, continuing to learn, continuing to own productive assets, continuing to give compounding time to work. That's where real wealth is built. Not in a single day, not in a single trade, but over decades. The power of compounding. Imagine planting a tiny seed. The first year doesn't look impressive. The second year doesn't look impressive either. In fact, for a long time, progress feels slow, almost invisible. But beneath the surface, growth is happening. Roots are spreading. Strength is developing. And eventually, the results become impossible to ignore. That's how compounding works. Most people quit too early. They expect dramatic results immediately. When those results don't appear, they lose confidence. But wealth isn't usually built through dramatic moments. It's built through consistency. The same decision repeated over and over again. Invest. Wait. Stay patient. Repeat. And over time, those simple actions can produce extraordinary results. So if history rewards patient investors, if fear often creates opportunity, and if ownership is the real foundation of wealth, then what should investors do right now? What's the lesson Warren Buffett has been teaching all along? The answer isn't about predicting the next market move. It's much simpler than that, and it may completely change the way you think about investing forever. The problem with waiting for certainty. Let's talk about one of the most expensive habits in investing. Waiting for certainty. At first, it sounds reasonable. Who wouldn't want certainty? Who wouldn't want clear answers? Who wouldn't want to know exactly what the market will do next? The problem is, certainty usually arrives after the opportunity. Think about it. When the economy feels perfect, stocks are often already higher. When headlines become positive, markets have often already recovered. When everyone agrees things are safe, much of the easy opportunity has already disappeared. That's why Buffett never waits for perfect conditions, because perfect conditions rarely exist. The truth is, every generation has a reason not to invest. In the 1970s, it was inflation. In the 1980s, it was economic uncertainty. In the 2000s, it was the dot-com crash. In 2008, it was the financial crisis. In 2020, it was a global pandemic. And today, people still have reasons to wait. But history shows something remarkable. The market keeps moving forward. Businesses keep innovating. Human progress continues. And patient investors continue benefiting from it. Think like an owner, not a trader. If there's one lesson that separates Buffett from most investors, it's this. He thinks like an owner, not a trader. A trader asks, what will happen next week? An owner asks, will this business be stronger in 10 years? A trader worries about daily price movements. An owner focuses on long-term value creation. A trader reacts to headlines. An owner studies fundamentals. And that's why Buffett has remained successful through so many different market environments. Because his strategy doesn't depend on predicting short-term events. It depends on owning productive assets for long periods of time. When you start thinking this way, investing becomes much less stressful. Instead of chasing every market movement, you focus on building ownership. Instead of reacting emotionally, you focus on long-term progress. And that's where real wealth is often created. Speculation versus investing. There's another important distinction. Speculation and investing are not the same thing. Speculation is often focused on quick profits, fast gains, short-term excitement. Investing is different. Investing is the process of owning assets that can grow and create value over time. Buffett has never built his fortune by chasing excitement. He built it through patience, discipline, consistency, and an understanding that wealth grows slowly before it grows significantly. That's a lesson many people struggle to accept. Because social media celebrates speed, investing rewards patience. And those are two very different mindsets. Why history may be being made right now. So why does this matter today? Because every historic wealth-building period begins before people recognize it, not after. The investors who benefited most from previous market recoveries didn't have perfect information. They didn't know exactly what would happen next. They simply believed in a principle. That productive businesses, innovation, and economic growth tend to create value over long periods of time. And they acted on that belief, while others waited. That's why history often rewards participants more than observers. Observers watch. Participants own. Observers analyze endlessly. Participants allow time to work. Observers wait for certainty. Participants accept uncertainty and move forward anyway. Buffett's biggest lesson. If you remember only one thing from this video, remember this. Warren Buffett's greatest advantage was never intelligence alone. It was time, and the willingness to stay invested long enough for time to do its work. Because wealth isn't usually built through one perfect decision. It's built through thousands of ordinary decisions. Saving consistently, investing consistently, remaining patient, ignoring noise, trusting the process, year after year, decade after decade. That doesn't sound exciting, but that's how many great fortunes are actually created. Right now, some people are waiting, waiting for certainty, waiting for better headlines, waiting for the perfect moment, and they may continue waiting for years. Meanwhile, history may already be unfolding. Businesses are growing. Innovation is advancing. Markets are evolving, and opportunities are quietly being created, not in the future. Today, no one knows exactly what the market would do next month. No one knows exactly what next year will look like. And that's okay, because successful investing has never required perfect predictions. It requires patience, discipline, and the courage to think long-term when everyone else is focused on the short term. That's the lesson Warren Buffett has been teaching for decades. Not that every stock will go up, not that every investment will succeed, but that ownership, patience, and time remain some of the most powerful wealth-building forces ever discovered. So if you're waiting for the world to become perfectly certain before you invest, you may be waiting forever, and by the time certainty finally arrives, history may already have been made. The biggest opportunities rarely announce themselves. They simply reward those who are willing to act while everyone else was waiting.